This is Robert Kraft, and I'm your host on SNN.Network. And joining me today for this Wall Street View is Rick Rule of Sprott. Rick, welcome back. Good to see you.
Robert, a pleasure to be with you. Happy New Year.
Happy New Year to you and yours as well. So to get started here, for my audience that may not have seen a Rick Rule interview that we have done yet, let's get your background real quick.
I'm 66 years old, a investor and speculator in natural resources, precious metals, and financial services. I am employed by and am the largest shareholder of Sprott Inc., a Canadian domiciled and listed company that manages money in precious metals and natural resources.
So, Rick, we last had you on for a Wall Street View back in November 2019, at the beginning of November. So let's get an update. What are some of the highlights or some of the bigger or lowlights or some of the bigger news stories that have affected the natural resources industry since then?
I think there are three themes. One is, of course, artificially low interest rates, which makes sovereign debt either negative yielding or nominally negative yielding. And of course, in that context, heightens the appreciation for and the perceived need for precious metals. The second macro theme is the perception, at least on a global basis, that economic conditions may be deteriorating. We have been involved in a global economic recovery for 10 years, depending on how you count them. From my viewpoint, an economic recovery without a recession for 10 years is, in a historical context, very long of tooth, although I would note that I'm not an economist. The first circumstance, which is to say, weak sovereign bond markets should be good for gold. The second circumstance, a global economic slowdown, could be thought of as bad for all other commodities. The third circumstance is, of course, continued deterioration of the geopolitical circumstance in the Middle East, culminating, at least in the near term, with the murder by the United States of the second most powerful official in Iran, and perhaps a heating up in the circumstance of what was perceived as a Cold War, first between the United States and Iran, and secondarily between Sunni and Shia Islam. My suspicion is that if this circumstance continues to deteriorate, that could be fairly supportive of energy prices, and perhaps mildly supportive of gold prices, but not very supportive of any other type of economic trade.
Mm-hmm. Well, it's interesting you brought up of the three factors, the geopolitical situation going on in the Middle East, and really just the geopolitical situation in general, especially looking at some of these prices for commodities that have come out here. We're recording this on Monday, January or the 6th. And to remind my audience, because there's some people that are going to watch this and say, okay, you're mentioning these factors, and why do they have this potential effect on certain commodities that for them, they're thinking, well, why? I don't understand. So can you give us a little background there?
Most commodities other than gold and silver, I think are in some ways economically dependent, meaning that in buoyant economic times, demand for those commodities grow, And at least in the absence of oversupply, prices tend to do well. We're in an interesting space right now with industrial materials because many industrial materials are priced below the incentive price for new supply. Copper, as an example, at $2.75 a pound, is priced substantially below the $3.50 a pound that is estimated to be required to stimulate a new round of construction of copper mines. So, in many industrial materials, we are threatened 3 or 4 years from now with the possibility of supply shortages. In a normal circumstance, that would be bullish. But in a circumstance where we go into an economic decline, if we go into an economic decline, demand could falter as well as supply could falter, which would, if that set of circumstances occurred, perhaps delay a recovery for several more years. Mm-hmm. No one that I know is in any danger of making any accurate economic forecasts. Warren Buffett famously said that predictions tell you a lot about the predictor, but very little about the future. So I would caution your listeners about taking my own predictions with regard to the economy too seriously.
Well, that's very funny. And trust me when I say this, there's going to be a question coming soon in this interview about that. But so I'll give you some time to think that through. But to follow up then on again on this geopolitical situation, you mentioned that I've done a number of interviews with you, Brent Cook, and a number of other speakers that focus solely on natural resources, and they say, sometimes geopolitical unrest is good for commodities like gold, sometimes silver. I mean, why is that? And in this particular case, why could that be?
My experience is that the lift that precious metals receives from geopolitical uncertainty is short-lived. Mm-hmm. There is an immediate impact on the market, but the market backs off. In my own experience for 40 years, the most important determinant of precious metals prices has been faith in or lack of faith in the ongoing purchasing power of sovereign instruments, particularly US dollar denominated ones, and in particular the US 10-year Treasury. While people express a concern about geopolitical events, the risk-off trade around the world for the last 40 years has been the US 10-year Treasury, a very deep and liquid market. When people become concerned about the ongoing purchasing power of the US dollar, as they became concerned, as an example, in 2000 and 2001, gold seems to do very well. And that isn't to say that during periods of concern about other factors, that there isn't some fear buying driven into gold. It's just for the last 40 years, in my experience, recoveries in precious metals as a consequence of geopolitical concerns has been fairly short-lived.
Mm-hmm. And so I think last I checked in terms of the gold price, and that was an interesting take because it seems that the take is when it comes to the geopolitical response or the response in the gold price from geopolitical situations. From what I've seen, and I haven't been at this as long as you have, but from what I've seen, it's been more or less the same, that it's very short-lived and it's kind of more or less a reaction to some of the news that's out there. But, still gold prices are there. They're still up at what, $1,500-$1,600. So I remember when they were last at these levels, you start to see a lot of capital flowing into some riskier, junior mining projects, maybe even some non-junior mining, but just riskier projects in general. Are you starting to see some of this happen again?
Yes, absolutely. The trend towards money flowing into precious metals and precious metals equities is a trend that's been underway for at least a year. The current circumstance may in the near term exacerbate the trend towards the metals, although probably not towards the mining shares. But the truth is that the dearth of capital that the precious metals mining industry experienced over the preceding 6 or 7 years is probably over, at least for the near term. There is a lot of money circling the space. Some of the money, it's important to know, is what you may call organic money, meaning that at $1,500 an ounce, the gold mining industry itself is finally generating fair amounts of cash. So one of the sources of capital that you're seeing being available to the juniors is capital that emanates from larger mining companies who are suddenly generating free cash, and in some circumstances, lots of free cash from their existing operations. A second source of cash is the sort of long-suffering gold equities investor, myself included, who suddenly understands that the wind is in his or her sails. But it's important to note, too, that the generalist investor is beginning to return to the precious metals markets. Sprott recently raised its second mining lending fund or mining debt fund. And we found the response from particularly U.S. generalist institutions, universities, and pensions was very robust. The interest was very robust, including from investors that don't have a history of investing with Sprott or in natural resources. And I think that's indicative of a newfound interest on a global basis in natural resources and particularly in precious metals.
Well, then, if so, you are saying that you're seeing this. So let's define what today's early 2020s riskier projects look like, because that's probably going to differ very much from some of the other risky projects we've seen, let's say as far back as 2011, back when gold was going up to 1800.
Well, certainly, if you want to start with risk, the riskiest endeavors are the grassroots or greenfields exploration businesses. Mm-hmm. And we haven't generally seen capital come that far down the feeding chain. The second level is probably brownfields exploration or mid-risk exploration. Similarly, the markets have not been kind to those circumstances unless they were led by very high quality management teams that also had a franchise in the industry. Mm-hmm. The next level of risk is advanced exploration, where there are ore grade drill holes in a deposit that is perceived by the industry as being attractive. And that sector is seeing lots of money. It's seeing money from speculators like myself, but more importantly, it's seeing lots of inflows from established mining companies who want perhaps ultimately to take that deposit over. The amount of money that's available with what we call drill-driven alpha, which is to say a deposit that has the potential for size and also has the third dimension. Several drill holes proving that the original thesis was true and that the grade of the deposit might be economic. We're seeing lots and lots and lots of capital available to that sector. Mm-hmm. Going again further up to the junior producer, there is a lot of interest in junior producers. First of all, interest because some investors, growth investors as an example, see that operating margins increase when you go from $1,300 an ounce to $1,500 an ounce, pardon me. What you're going to see is margin growth at the same time that you see margin expansion. The second thing that you're seeing with regards to the junior and the mid-tier producers is the expectation of merger and acquisition activity. Mm. The industry has too many management teams, too much G&A, and this amalgamation is required to get the G&A under control. It's also true that equity markets more and more are becoming passive and machine traded, and larger companies enjoy more trading volume, more liquidity, higher share prices, and therefore a lower cost of capital. So my suspicion is that what's really beginning to drive the junior producers and the intermediate producers is the knowledge on the part of investors that we're going to see a continuation of the massive wave of merger and acquisitions that we have seen in the past, all the way from the largest down to the smallest. Mm-hmm. You're going to see sort of lateral acquisitions, that is takeovers of equal, like you recently have seen with Lee Gold and Equinox as an example. And you're going to see larger companies taking over smaller companies.
Mm-hmm.
Mostly, I think what you're going to see is the takeover of single asset companies, which, because of their greater risk, that is, their reliance on one project, trade at larger multiples than multi asset companies. And it's by definition a circumstance that when a company that operates three mines takes over a fourth mine, you eliminate the single asset objection and therefore eliminate that reason for a market discount. The consequence of that is that I think over the next 18 to 24 months, you're going to see more of those acquisitions, which is one of the reasons why you're seeing an incredible flow of capital into that particular subset of companies.
So I have a follow up to that but before I get there, you mentioned two companies in that previous answer. Just need to know if you are a shareholder or were a shareholder in, I think you said Leagold and Equinox.
Very large Equinox shareholder, not a legal shareholder. Equinox is, of course, the latest vehicle by the serially successful Ross Beatty, mm-hmm. whom I have done business with and profited with for 4 decades.
Mm-hmm. So then my follow-up to this trend that you're seeing right now is that and I talked about this with Brent Cook, I think in maybe an interview or two before, and it has to do with the being able to forecast when cycles are going to be changing. Because if you're going to just be responding to every geopolitical event or any black swan event, and then that's when you're going to go and plow money into more exploration and actually going to go build the mine when that's actually happening right now, like that just doesn't seem economically responsible, so I mean, my humble take, I guess I'd say.
But you're generous of you, actually.
So for you, I mean, how do these companies, how are they able to time the markets so that you start to see these trends kind of happening? Because for the lay investor, sometimes that might be very difficult to predict when you don't have, all the tools at your disposal.
Companies time the market extremely poorly. They do what they can when they can. So, or what they need to do when they can. So I wouldn't look to companies as indicators of good market timing. An example would be in the middle part of the last decade when capital was freely available to the major mining companies. They took advantage of that by being incredibly stupid. So as I say, I wouldn't look to them for leadership. I would point to a different direction, and one that is very, very, very hard to follow, which is to say you must be an absolute contrarian. When you feel the worst about the sector, when it has punished you most severely, is the time that you have to be the most aggressive. Difficult to do. Similarly, when you've been through 2 or 3 or 4 years of a good market, when you come to believe that cyclical businesses are in fact good businesses, and when you get confident, when you believe in your own ability and think that you've come to understand the sector, that's the time to be extremely, extremely cautious. People are interesting. In most circumstances, they look for sales. If you were going out looking to buy a winter coat, as an example, and you saw a nice coat that had been marked down from, say, $250 to $150, you'd be attracted to that coat. Conversely, if you saw a $150 coat that had been marked up to $250, you'd think that the merchant was taking advantage of you. But we seem to shop for stocks differently. If a coat's been marked down from $250 to $125, it's the same coat. People find it less appealing. Similarly, if that coat is marked up from 125 to 250, people think it's better. We seem to want to overpay for financial assets and underpay for other assets. And the truth is that we need to think about buying companies the same way we buy coats.
Mm-hmm. So what would you say right now is really an existential threat to the natural resource industry today, January 2020?
I think there are two. One is the tendency towards politicized envy around the world. the idea that government is the answer to any problem, which leads to resource nationalism. The last round of resource nationalism that we had worldwide, we saw countries as disparate as Peru, Brazil, Zimbabwe, Zambia, Congo kill first class mining economies. Only a politician, only a politician can make a tier one deposit unprofitable, but they're amazingly competent at doing that. So I would say envy and politicization is one problem. A second problem would be a synchronized global economic decline, a circumstance where we had, a sort of a revisitation of the type of economic discoveries, economic difficulties that we had in 1982, 83, 84, perhaps preceded by a liquidity crisis of the type we had in 2008. This is not, by the way, a forecast. This is merely an answer to the question. Very, very difficult economic circumstances, particularly if they're accompanied by trade wars, as they often are, means that everyone is poorer, everyone's purchasing power goes down, and hence demand for basic commodities like copper and oil declines as well.
Speaking of trade wars, I was going to come to this question. We're in 2020. We have a big election coming up. What are some of the implications of the 2020 election on the natural resources industry, potentially?
Well, I think they're becoming potentially profound. One issue in 2020 that seems to be almost certain to be resolved poorly will be the deficit. The idea that we as a people can continue to afford, and I'm talking about Americans right now, can continue to afford a $20 trillion on-balance sheet liability and a $100 trillion off-balance sheet liability, and that we can service this debt with the national income, which is to say set taxes and fees minus expenses, that's $1 trillion deficit, is the biggest domestic issue, in fact, that I think we face. It amuses me that the big thinkers in the world, otherwise known as Democrats and Republicans, both seem to believe that you can add a column of negative numbers and come up with a positive sum. Now, the upshot of this, and you should be more angry with this than me, is that my generation has made ourselves a whole bunch of promises at the ballot box. But we've decided that you all, the younger people, should pay for them. I don't think that's going to be resolved in 2020 because, ironically, a whole bunch of your generation thinks that socialism is a good thing. I guess because you believe that you're going to get free goodies. What you don't understand is that we already stole them all. So the biggest issue in front of us, I think, is collective innumeracy and collective stupidity. But there are certainly other ones, all of which are political. It's interesting when you talk about the word politics. I like to joke that you can understand it by examining the root words. Poly, of course, from the Latin for many. Tick, from the English colloquial for small blood-sucking insects. You can think about an election as a competition between many small blood-sucking insects. H.L. Mencken, I think, said it best when he said, an election is best understood as an advanced auction of stolen property, which is certainly what the 2020 election is going to be. Which candidate can buy the most votes by stealing on behalf of focused interest groups at the expense of everyone else, including prominently the unborn? You can tell that I'm not an optimist with regard to the 2020 election. It will be between Tweedledum and Tweedledummer. It's just that we don't know which is who. Going back to trade wars and tariffs, what are they? They're taxes. They are a way to steal money from a market. And yet some people benefit. Well, in every case, I guess, where theft has taken place, the thief could be identified, at least in the near term, as the beneficiary. but that doesn't mean that thieving is good business.
Mm-hmm. Oh man, there's so much to unpack there that I think we're gonna have to save that for the next interview as we get closer. But I do want to follow up also on that, and really, you mentioned a few implications. Obviously, we talked about the elections and some other trends and maybe even some other catalysts for 2020. But what would you say are some of the main ones that you're focused on, that you're really looking at, that investors, my audience, should also look at in terms of catalysts and trends for the rest of 2020?
I'm, as you can tell, fairly pessimistic politically. I suspect that your listeners who are Democrats fear a Republican victory. I suspect that your listeners who are Republican fear a Democratic victory. I don't see a happy outcome. Mercifully, in the United States, we have such an innovative society that almost irrespective of how stupid we are collectively, it's still a place where 5 or 6 young people can commandeer a garage in Silicon Valley and out pops Google. So my suspicion is over the next 4 years and over the next 8 years, our individual skill sets will allow us to survive and thrive despite the stupidity of the people that we elect. What policies that are beneficial could come out of the 2020 election? None that I can think of.
So, for more information about you and Sprott, where can my audience go and find all the information they need to know?
I'll give them an incentive. To the extent that your listeners and readers would like to get to know Sprott better, particularly if they're natural resource investors, they can send me a copy of their natural resources portfolio. Names and symbol in text, please. Don't test a 66-year-old Luddite with an attachment. Email those to me at rankings, rankings, at sprottglobal.com. On a no obligations basis, I'll rank every company in your portfolio, at least every one I've heard of, from 1 to 10, and comment on them when appropriate. To the extent that you want less specific information, that is, of information that's of less need to you immediately, of course, go to our website. We have two, www.sprott.com, and for American investors, www.sprottglobal, SPROTTGLOBAL.com. Once again, for the portfolio evaluations, rankings at sprottglobal.com.
Rick, thank you so much for joining me today. I always appreciate having you on to share your insights, and look forward to speaking with you soon.
Always a pleasure. Thank you for the opportunity.
Thank you, Rick.